a few more people, and people can join as they come on. So I'm gonna go ahead and jump into this. Some some housekeeping. I've muted everybody, but you can ask questions. We have a little chat available. So as we go through this, please ask questions because I will answer as I go as it makes sense to do that. Um, and then yeah, so if you have anything, we can always jump into it from right there. All right, so let's get started today. This is all about taxes. And so we're going to talk a lot about the tax tab here. I have an example pulled up that'll kind of work through. So I'll introduce you to Sid and Jane and a little bit about their world. And then kind of go into the tax tab of, the things that we're looking for, and then some of the newer tools that we have within the tab that RightCapital has continued to add through the years. So let's jump into it. So those that are familiar with RightCapital, this is kind of gives you a quick snapshot of their world, a balance sheet view, things like stability of income, effective tax rates, total effective tax rates, withdrawal rates, sources of income, allocation. So, but today we're going to focus on the tax part. Now, to do that, we need to know a little bit about Sid and Jane. So quickly, I'm going to jump into their profile and who they are so we can kind of get a feel of what their situation is. And so we have Sid and Jane, 57, 56. They have two I'll say adultish children, 27 and 22. Within their kind of situations, Taylor is actually going to graduate school, which Sid and Jane are paying for. Alex is out in the world doing his thing. Expenses, they are in the state of Texas, so they are filing in the state of Texas, so no state taxes on that part of it. Their monthly expenses outside of their mortgage is $5,000 a month. Currently, savings, both Sid and Jane are maximizing their 401k. So they're putting a good amount into their retirement savings at currently. Income, both of them make a pretty good income. Sid makes 125, Jane makes 150,000. Um, Filing age on Social Security, all things kind of important when you think of the global planning part of it. They both plan to take Social Security at age 67, full age retirement. Some of their goals, so they both want to be done at 62. So that means Sid is going to retire a year before Jane. Retirement expenses outside of their mortgage, they think their expenses actually may go up because they'd be more doing more things. We've estimated uh, healthcare costs, long-term care cost, and then we have some goals. As I mentioned, Taylor's college goal, which is going to be over the next couple of years that they're going to be paying for. Um, and they wanted to build out a vacation goal. They like to take vacations with their kids, and they like to do one that's just them on an annual basis. So they wanted to set aside that goal above any other kind of day-to-day expenses. So that gives you a little bit about kind of their baseline. Looking at some of the things they have currently from an investment standpoint and asset standpoint, have a good chunk of money in the bank, joint savings accounts, checking accounts, CDs, over 200 in CDs, investments, both sizable investment accounts. Sid and Jane both have about 750 in their current 401ks that they are continuing to max out to. Have another 200K in a taxable account. And then Sid has a rollover IRA that he had at another 250. So close to about $2 million in assets. So a good amount of assets as they approach retirement. And again, they're able to max out at this point. They do have a property that's 650,000. They have a loan against that property, 350,000, which they have a monthly payment of about 30 or 3,100, almost 3,200 there. So that gives you kind of an idea of their world and what they have going on. And so you can never talk fully about taxes without kind of looking at an overall planning view. So I'm going to jump into this retirement section here. And without jumping into these numbers here, I'm going to jump directly into cash flows. And what I want to show you here is what they have from a planning standpoint, some things that they have to account for. And when we start to look at taxes, I think this will make more sense of why we need to take a look at these things from a kind of a global view. So currently their income flows from year to year. This year they're looking at 275. Expenses, goals, taxes, planned savings, their outflows are about 265. So they have roughly about 10 grand that can go into savings, fund, whatever that may be. And so if you extrapolate that out over the next few years, again, they have a good college planning that they're paying for right now with their daughter. That'll be over in a couple of years. So they have some more money that they could again account toward savings or whatever it may be. But when that income starts to go away, when Sid retires in 2031 at age 62, all of a sudden they have a shortfall. And, based on their expenses and what they want to do, they need to come up with, 58,000, let's call it 60. And then as both those incomes fall off based on expenses, those are sizable numbers that they'll need to come up with. Now, why do I want to show that? Because as we jump over into the tax tab, this is what we're here to talk about today. And so when we start talking about taxes, a tax estimate on any data, whether it be tax planning software that includes some of this, these are all estimates and it's based on the data that we have going into here. So as good as that data is, these estimates can be pretty much right onto the penny. But, from person to person, it's not only what is your W-2, but what other things that you have out there that, maybe don't show up on a day-to-day basis. So it's important to really kind of make sure that you have all those little things because they do add up over time. But falling on Sid and Jane, currently based on their income, effective tax rates, 13% as they move forward. Again, Sid retires, that drops down. And as they both retire, there's that window that we saw that we have to make up. Now, their lives didn't go away, so we will have to replace that income. But that is a window there where, we don't have anything from a W-2 standpoint coming in. So their tax rate jumps down. Looking at income brackets at 22% rate. Again, as this falls down, it goes down to the lowest rates depending on their situation. Capital gains, again, as they go down, the limit on that is right at over 48,000. So as they have no income, their federal gains goes from 15 to 0. And again, as they kind of have those gains. From a strategy standpoint, obviously, when it comes to taxes, we're not going to have zero. So we're going to have to either fill that in. And so if we fill in just what we need, looking at a proposed plan, our taxes don't really start to go away until, again, I have it planned here from Social Security that we filled in those kind of gap years. But that might be also from a planning standpoint where we look at taxes and look at, does it make sense to do Roth conversions? And so with these tax tools, we can see what they are based, what your tax rates look like based on today. But looking at some of the different tax strategies that we can look at, it's also kind of looking into the future. What do we want that to look like moving forward? And so there's several different things. Some of this has been around within the software. Some of this is a little bit new. So from a tax strategy, we haven't done anything yet. We haven't looked at anything that Sid and Jane could do. We've just kind of said, okay, based on what you're doing now, we're not changing any of that. Asset allocation. This is one of the things that's kind of overlooked when you start thinking about taxes and how your income plan is set up, is what investments sit in what types of accounts. So we have taxable accounts, we have tax deferred accounts, and we have tax-free accounts. And obviously we can't always control where our money is kind of going into this. And so what I mean by that, if we have W-2 income and we're saving into a 401k, Well, maybe they only had tax deferred. And nowadays there's a lot of Roth options within those plans, but that wasn't always the case. And if you made too much money, you couldn't put into individual Roth. So a lot of times it was hard to get some of this tax-free money built up. But if you're able to do that, the types of investments that work really well here are any type of investments where there's going to be some turnover. If there's buying and selling, well, within the tax-free or tax-deferred, those investments are not impacted at all. And so those are great places if you're going to do that type of trading where you're buying and selling. Inside of a taxable account, every time you buy and sell, all of a sudden there is a tax consequence with that. Now there can be, tax loss where you're kind of harvesting losses. There can be tax gains. And again, is that taxed at capital gains? Is that taxed at zero capital gains? That's all dependent on, your situation and your income any given year. So when you start doing planning, the investment part, what investments are producing income, what type of accounts are, all kind of dictate what your taxes look like. With tax-free or tax-deferred and tax-free accounts, the taxes occur when a withdrawal happens. And again, with the taxable accounts, those taxes can occur when there's a selling event. And again, that could be a loss or a gain or somewhere in between. But that's where the taxes are growing. So, when we're W-2 employees, we really kind of control what those taxes and where they go. Once we kind of go past and we're into retirement and we're producing income off our investments, well, depending on how our allocations are set up or where our assets live, can kind of tell you what those taxes and what types of taxes we're going to pay, whether they're going to be 1099-R or they're going to be, a 1099 summary where you have dividends and interest and all the different things that you can have there. So, very important piece because some of those investments work better in other types of accounts. Calibration, again, I'm not going to go into this all the time, but all the things that kind of go into, does it make sense to do these types of conversions? So not only the ordinary tax bracket, so you can see in their situations, their taxes go down. So there might be some opportunities to kind of fill in those gaps to stay in with certain tax brackets. Where's their money going to be coming from over the time? So currently it's purple, it's salary. At some point, there's going to be withdrawals from tax deferred, investment income, Social Security. So how is that all broken out from, over time? Um, Looking at capital gains, again, are they going to be at that 15% or zero? In this case, they're primarily going to be 15%. Doesn't look like they're going to get into that top tax bracket. Medicare, this is another one when we start talking about Roth conversions that you really have to pay attention to because not only are you going to pay taxes on that possible conversion, but depending on what frame that puts you in, you could also pay a extra expense on your Medicare. So again, based on these tax brackets, that could be from as low as $96 a month up to an additional $530 per person. So again, those are larger numbers. We're talking about 333,000. But if you're looking at doing large conversions over a short period of time, you just have to be aware that there could be some expenses on the back side of that as well, not only on the front side. All right, so the newest things, we've had some of these tools. One of the newest things within here now is strategies, and it goes to from using the tools of the day, AI and everything else, to what is the top strategy based on their individual situation. So what it suggests is from an allocation standpoint, again, it'll tell you where to pull from first, taxable, tax-free, tax-deferred, or I'm sorry, from an asset allocation standpoint of where it makes the most sense to have the most assets, withdrawal strategy, how you want to pull from those assets, and then a Roth conversion strategy. What makes the most sense of the is the 12%. So kind of building that out really quick, looking at a proposed strategy of, okay, we want to do taxable, tax-free, tax-deferred, uh, taxable, tax-free, tax-deferred, and then we want to fill up the tax brackets up to 12%. And very quickly, we can see how did that change our situation. And, in this case, that added quite a bit of more in tax adjusted ending assets. It means they also pay less taxes over the long term, and it means they took a lot less from those tax deferred accounts. So how does that actually look? Let's take a look at the comparison here. So from an invested asset standpoint, um, again, change the assets level from quite a bit there. Um, Federal taxes, much lower federal taxes, required minimum distributions, again, almost $250,000 less there. Tax adjusted ending wealth, again, changing the structure of where that money is, goes to 40%, 46% tax free. Withdrawal, again, just kind of shows all the different ways that from the proposed strategy and then account balance. Again, a good portion is now green, which means is tax-free, again, 46%. Now, you may look at all this and say, hey, that is the best thing ever. The numbers don't always look like this from it. It's a kind of a slam dunk decision. It's like, yeah, I can make just doing that strategy can make $2 million more. I definitely probably want to do that. It's not always so clear cut on some of this. And so, some of these things that may matter for one person may not matter for the next. And so, looking at account balances is, going to that next generation to their kids. Well, all of a sudden, you gave the kids, uh, you know, 40% of their inheritance is now tax free. And for them, that makes a huge, huge difference. Not everybody looks at that the same. And so you always want to make sure it makes sense for your situation. And then the details also matter too, because this is where, you know, it looks really good on paper, but then you start looking at the reality of, okay, how much am I actually going to pay in taxes in these given years? And you can see that with these large conversion amounts, that there's going to be some taxes with that. So your taxes definitely jump up as you're doing these conversions, as you can see here. And so the other thing to think about when it comes to conversions, and I know my clients have always heard me say this, is much like Social Security, there's also break even points with that. And so when we look at these comparisons, that is assuming that we live to age 90. And depending on your situation and your kind of family history, well, maybe age 90 isn't realistic. And so when you start thinking of federal taxes paid, well, you can see there's quite a big jump here and then here versus what we were going to pay. Well, if we go through this conversion and then we pass maybe earlier than we think, well, all of a sudden we paid a lot more taxes than we meant to. And so there's always those numbers that you have to look at. And again, where this particular scenario kind of looks like a slam dunk, but you always have to kind of factor in all the things within, for your life and your family history as well. All right. And then the newest tool here is the tax analyzer. So this is kind of looking at, things that we can do from Roth conversions and things like that. Tax Analyzer is actually looking at your taxes today or within the last couple of years. So one of the newest things that we can now do is actually upload one of your old returns. So we can, starting with your 2023 return, we can upload 23, 24, and then soon here 25 as people start getting their tax returns. And what it will do is make sure that we're taking advantage of everything that we can. And so, and again, it'll pull in your 1040 Schedule 1, Schedule A, and make sure that, again, line by line, that it has all the information. But making sure that we're taking advantage of all the thresholds that we can do, whether it be child tax credits or net investment income tax, anything and everything that shows up on your taxes, we want to make sure that we're taking a advantage of when it comes to this. And so then coming to the comparison side of things, again, if we're making changes, kind of gives you an idea of, okay, basis of what it is today versus the original, what does that mean? And so if we're looking at maybe adjusting some of the investments from one type of account to the other. Are there taxes or capital gains to do those types of things? And that's where we can kind of run scenarios to make sure, okay, we're staying within one bracket or the next. Again, very client dependent on their situation. But one of the nicest things is once you have all this uploaded and kind of go through details, um, it gives us, your true effective tax rate, income tax rate, capital gains, anything that you had. Um, and then one of my favorite parts here is it gives you also your ordinary income tax bracket. And so again, shows you all the tax brackets based on your scenario, whether you be married, single, head of household, all the different things, but shows you what you're paying for the income coming in. And again, if we're trying to stay within certain brackets, this really kind of gives you an idea of where you need to be, and from anything above that, really gives you an idea of like, okay, how much income is actually being taxed at that 22% rate. And so when we start doing planning for the next year, really, it depends on your situation, but we can really start, factoring in where do we need to be? Do we have leeway? Because a lot of times, in their case, if they want I think it was close to 200,000 there, it doesn't matter, what the tax rate is our expenses are our expenses. And so, sometimes we don't have any wiggle room and we need to come up with what we need to come up with. And from a tax rate standpoint, that kind of settles what that'll be like. But if we have some leeway, or we have an idea of like, okay, actually we don't need that much income on an ongoing basis, we can try to stay within certain brackets. And again, obviously that'll help pay less taxes along the way. So again, all in all, with all this information that we have today, the coolest things is, again, utilizing some of this AI to solve for these strategies when it comes to tax conversions, Roth conversions, and then using AI to analyze your tax forms, making sure that we have all the data, making sure you're taking advantage of all the different things. And then really, when I think about whether my clients are still working and have W-2 income or business owners, depending on the kind of their income type, planning and tax planning really, 2025 is over, even though, people are just now filing taxes. There's no really planning at this point. So really looking at 26, 27, uploading those returns, we can kind of get an idea of what that looks like. In our W-2 years, we kind of know year to year what that income looks like. In our retiree years, when we're producing income, well, that's where that can really change to fit your actual life. And it really does make a difference to, if I have a lifestyle that's $60,000 to really produce to $60,000, because it's going to save you, from a tax standpoint. So all those things can kind of matter, but when you start looking at planning for that 2026, especially for retirees, we're going to be withholding taxes. So making sure that we're withholding the right amounts. And again, all of it making sure that, we fit for what's going on in the world, because everybody's situation is a little bit different. And, as I said in the beginning, having good data and making sure that we have all the data within our systems so that we can actually give you, an idea of what these tax estimates look like. Because one of the coolest things about this software is if we have it in, it will definitely show you what your taxes are almost to the penny. So again, very, very detailed. And again, this next level here with the tax analyzer, the ability to take your actual data, and kind of carry that forward. And that's kind of the back and forth, kind of looking into the future of this is what it was last year, whether it be W-2 or whether it be retirement income. But this is what I'm expecting for 27 or 28 or 29. And that's where always the planning piece kind of comes in of, what events in your world, what changes are in your world. Do I need more income, less income? Well, pretty much nobody is less income. But so all things we can kind of take a look at and make sure that, we all know where we stand and what we're producing and what we need to do. So again, RightCapital continues to release these tools to continue really kind of keep track of this. it's really interesting because all the technology vendors that I do use are really applying all this new, AI tools with it to enhance what they have. And so RightCapital is right there with everybody else and continue to upgrade their features. And so I'm very excited about that, and really excited to see what they have into the future, because it really does kind of help guide myself, my clients, from that standpoint. So um, it looks like I don't have any questions here. So that is it for today. I hope this was helpful, give you kind of an overview of some of the new tools that Right Capital has. If you have any questions, I'll be sending out a recording to you, or a link to the recording, so you can take a look at it if you want to review on your own time. So thanks for stopping in, and I hope you all have a great day.